if you check the S&P 500 today, um, it looks like a standard, maybe slightly bumpy Friday on Wall Street.
Right, you see that 2% drop and you figure, oh, we just hit a little pothole.
Exactly. It feels totally manageable. But underneath that top line number, the average tech stock is secretly sitting in this brutal 31% crash.
Yeah, it is the absolute definition of, well, structural market camouflage.
Camouflage, right? Because the dashboard says you're cruising fine, but the engine is actively on fire.
Exactly. What you see on the surface right now is actively hiding the sheer severity of what is happening underneath.
Well, welcome to a brand new deep dive. It is Friday, March 27th, 2026, and our mission today is to really unpack this wild week on Wall Street.
It has definitely been wild.
It really has. We are going to decipher the underlying macro and geopolitical causes of this market drop, look really closely at how the Magnificent Seven are weathering the storm, and figure out exactly what analysts are saying you, the listener, should actually do next.
And before we get too deep into the data, we do need to explicitly state that this deep dive is strictly for educational purposes only.
Right. Always important.
Yeah, we are analyzing these reports to help you understand the financial landscape, but always seek professional financial advice before making any actual investment decisions.
Absolutely. Now, to cut through the noise today, we have a massive stack of fresh reports. I mean, we're looking at detailed Q1 and Q2 2026 outlooks from Morningstar and Morgan Stanley, technical market analysis from Charles Schwab, and a bunch of updates from global news trackers.
We have a lot of ground to cover.
You really do. Okay, let's unpack this. We need to establish exactly what just happened this week, right, before we can diagnose why it's happening.
Right, you have to look at the symptoms first.
Exactly. So the dashboard numbers are definitely bruising. The overall U.S. market index fell 2.03%. The S&P 500 fell just over 2%, meaning it is now down 8.7% from its January 27th record high.
Ouch!
Yeah, and the NASDAQ took a massive 3.23% hit.
Right, but as you mentioned at the top, those index numbers, they're really just a fresh coat of paint over a structurally crumbling house.
Yeah.
When we look under the hood, using the data we have from the Bespoke Investment Group and Charles Schwab, the actual mechanics of this sell-off becomes so much clearer.
Because it's a cap-weighted issue, right?
Exactly, because the S&P 500 and the NASDAQ are cap-weighted, meaning the absolute largest companies dictate the direction of the whole index. They are completely masking the pain of the smaller companies.
So the big guys are holding up the roof while the floor collapses.
Yes. I mean, yes, the S&P 500 index is down about 7 to 8% from its recent highs. But if you isolate the average individual member within the S&P 500, that stock is actually down 17%.
Wait, 17%.
Like,
Which means the median experience for an investor holding individual stocks is like twice as bad as the index actually suggests.
twice as bad. And the tech-heavy NASDAQ is even more dramatic. The index itself is down, but the average NASDAQ member is currently sitting in a 31% drawdown.
A 31% drawdown for the average tech stock.
Oh.
I mean, that really highlights how much the massive multi-trillion-dollar companies at the top have been holding up the entire market, right? While everything beneath them is just getting completely hollowed out.
Hollowed out is the perfect phrase for it.
And looking at the sector breakdown from Morningstar and Bespoke, the pain is highly, highly concentrated. 16 of the 25 S&P industry groups finished this week at least 10% below their 52-week highs.
Right.
And 4 of those are in actual defined bear markets, meaning they are down 20% or more.
And, the specific sectors taking the hits tell a very clear story about where capital is fleeing right now. Real estate management is down a massive 35% from its highs.
Wow.
Software is down by nearly a third. Autos and parts, along with commercial services, have also tumbled way past that 20% bear market threshold.
So it sounds like looking at the major indexes right now is it's less like the Titanic sinking all at once and more like passengers violently rushing from one side of the boat to the other.
That's a great analogy.
Like, the boat is technically still afloat, but the individual decks are just getting trampled. Is the damage really that widespread?
It is, and that is a perfect way to look at it. Charles Schwab's analysis describes this exact mechanism. They call it a process of rotation and churn.
Rotation and churn.
Yeah, investors are aggressively pulling capital out of these vulnerable sectors and shoving it into safer havens. That violent movement destroys the value of average stocks, but keeps the overall index from completely collapsing.
Because the money hasn't left the market entirely, it just moved.
Exactly. And the fear driving this churn is palpable right now. The VIX is hovering right around 30.
Just for context for you listening, a normal calm market usually sees the VEX, which measures market volatility and fear sitting somewhere around maybe 12 or 15. So hitting 30 means we are officially in high-stress territory.
Precisely. At a VIX of 30, institutions aren't just selling their positions, they are actively loading up on put options.
Right, the insurance policy.
Mechanically, yeah, a put option is like buying a short-term insurance policy. You pay a premium today for the right to sell your stock at a set price later. If the market crashes, that insurance policy pays out massively.
This way you're protected.
Right. And the fact that investors are willing to pay top dollar for that downside protection right now, it tells you exactly how incredibly nervous the big money really is.
So if the market is aggressively turning under the surface, and institutions are buying crash insurance, we have to look at the catalyst.
We do.
We know the symptoms in the stock market. Now we really need to map out the macroeconomic and geopolitical causes. And looking at the global news trackers, the dominant catalyst right now is obviously the ongoing war with Iran.
Right.
Now, I want to be incredibly clear with you. Our goal here on this deep dive is to impartially report the facts exactly as they are laid out in our source material.
Trigger the facts.
Exactly. We are absolutely not endorsing any political viewpoints from the left or the right. We are simply mapping the information that is actively driving these economic shifts.
Because the market reacts to geopolitical reality and supply chain threats completely independent of domestic politics.
Exactly. The market doesn't care about your politics. It cares about supply.
Yeah.
So according to the reports this week, former U.S. President Trump has stated that he suspended targeting Iranian power plants until April 6th to allow for negotiations, claiming the opposing forces are on the run.
Okay.
Meanwhile, U.S. Secretary of State Marco Rubio stated that military operations are expected to end in weeks, not months, and added that objectives could be met without utilizing ground troops.
Right.
On the other side of the conflict, the Iranian parliament speaker, Mohammad Baker Kalibaf, claimed that fake news is being actively circulated to manipulate energy markets and artificially lower prices, stating that the true prices will eventually emerge.
And, it is that exact tension over energy markets that is providing the immediate spark for Wall Street's fear right now.
The oil threat.
Yes, the threat to the Strait of Hormuz, which is a massive choke point for global oil, has a direct mechanical consequence. It causes an oil shock. We saw Brent crude oil jump over 5.5% this week to hit $114 a barrel.
Wow.
And WTI crude is trading well over $100.
And we have to explain how that mechanically flows through the economy, right? Because it's not just about paying more at the gas pump. When oil spikes to $114 a barrel, every single physical good that gets put on a truck, a train, or a cargo ship suddenly costs more to transport.
Every single one.
Right. And that transportation cost gets passed directly to the consumer at the grocery store and the retail counter. It acts as an aggressive, immediate tax on consumer spending.
Which is absolutely devastating considering consumer spending makes up about 70% of the entire U.S. economy.
70%.
Yeah, when the consumer feels pain, the entire economic engine slows down. And the data from the University of Michigan proves this is happening right now in real time.
What are you seeing?
They just reported that their consumer sentiment index plummeted to 53.3 in March. That is the lowest point of the entire year.
Oh, wow.
Even worse, consumers' short-term inflation expectations just saw their largest monthly increase since April 2025. They spiked up to 3.8%.
So consumers are depressed, they're scared, and they fully expect the cost of living to just keep rising.
Which brings us to a really critical insight from Charles Schwab regarding the Federal Reserve. Because of this specific dynamic, an oil shock driving up prices while consumer confidence completely drops, the Fed is completely cornered.
They're trapped.
They are totally trapped by their dual mandate.
Right. The dual mandate being their two legal jobs: keep prices stable by fighting inflation and maximize employment by keeping the economy growing. Usually they pull the interest rate lever in one direction to solve one problem.
Exactly.
Yeah.
But right now, those two jobs are in direct conflict.
Right. Stagflation vibes.
Yes. Inflation is resurfacing because of the war and oil prices. The traditional mechanical playbook says the Fed must hike interest rates to cool off that inflation. But they can't.
Right. If they hike rates now, or honestly, even if they just keep them at current levels for too long, they risk making borrowing so expensive that they cause a severe economic slowdown. They would crush an already frightened consumer.
So they're paralyzed.
The futures market sees this trap perfectly. Earlier in the year, investors fully expected the Fed to execute multiple rate cuts. Today, the market has completely priced out any rate cuts below the current 3.5 to 3.75% range for the rest of the year.
Zero chance.
The odds are at absolute zero.
But wait, let me push back on that for a second. If the Fed is stuck at that 3.5 to 3.75% range, and the market knows they're essentially paralyzed, why is the bond market screaming something entirely different?
Right.
Looking at the data, 10-year Treasury yields are approaching 4.5% again, and 30-year mortgages, which closely track those 10-year yields, are suddenly surging back up to 6.5%. If the Fed isn't raising rates, why is the cost for a normal person to buy a house suddenly spiking? If we connect this to the bigger picture, the answer isn't coming from the Federal Reserve at all. It's coming from Washington and the Pentagon.
Okay, we'll unpack that.
The bond market isn't just reacting to the Fed. It reacts to pure supply and demand. The Pentagon just requested a $200 billion emergency supplemental funding package to cover the cost of the war.
And the government doesn't just have $200 billion sitting in a checking account.
No, they do not.
They have to borrow it.
Right. The Treasury has to issue new bonds to raise that cash. But here's the mechanism. Investors are looking at a U.S. debt load that is already approaching $40 trillion.
This is a staggering number.
And now they see potentially hundreds of billions in new war spending being added to the pile. So at the Treasury auctions, demand is soft. Investors are basically saying, if you want me to buy this new debt and take on this risk, instead of keeping my cash somewhere safer, you have to offer me a much higher interest rate.
So the government is forced to raise the yield on those 10-year treasuries just to attract buyers. And because 30-year mortgages are benchmarked directly against those government rates, the moment the Treasury yield goes up, your cost to buy a house spikes right back to 6.5%.
You've got it. The geopolitical shock forces government borrowing, which forces bond yields up, which directly tightens the screws on the everyday home buyer.
Okay, so let's sort of summarize the landscape we are dealing with right now. We have a violently churning stock market, a consumer being squeezed by $114 oil, a paralyzed Federal Reserve, and a bond market demanding higher yields to swallow this ballooning national debt.
It's a tough environment.
It really is. And traditionally, when you have high interest rates and a cautious consumer, high-flying tech stocks are the first to get absolutely punished, right? Because their valuations rely on cheap borrowing for future growth. So how did the giants, the Magnificent Seven, perform this week amidst all this macro chaos?
Well, they definitely felt the pain. These are the companies that usually carry the index, as we discussed, but this week, they were heavyweights pulling it down.
What were the numbers?
Amazon was down 4% for the week. Meta was down 4%. And NVIDIA dropped 2.2%.
Which begs the question, if the broader market is being anchored by these massive companies, are the anchors themselves starting to crack? Like, are we watching the great artificial intelligence tech bubble of the 2020s finally burst?
And that is exactly where the Morgan Stanley Q1 2026 report provides a massive reality check.
Oh.
Yeah, their analysts looked deeply at this exact narrative, this idea of an AI tech bubble bursting, and their conclusion is a definitive no.
Really? Because the vibes out there feel very bubble bursty.
I know, but when you look at the data Morgan Stanley compiled, it absolutely shatters the assumption that the Magnificent Seven have just been coasting on blind hype this year.
What did they find?
Only 3 of the Magnificent Seven stocks have actually outperformed the S&P 500 year to date.
Wait, really? Only 3?
Only 3, which is incredibly counterintuitive when you consider that these 7 companies have delivered vastly superior earnings per share growth compared to the rest of the market.
Okay, so their earnings are up, but their stock prices haven't been skyrocketing.
Exactly. High levels of skepticism from investors have actually kept their valuations somewhat constrained. Morgan Stanley makes the case that there absolutely was a tech bubble, but it wasn't the Magnificent Seven.
Here's where it gets really interesting.
Yeah.
Because if the big tech companies actually have the earnings to back up their valuations and their stock prices have been constrained, then the bubble must have been hiding in the speculative AI startups.
Bingo.
The ones promising to, revolutionize the world but bringing in zero actual revenue.
Spot on. It was a very specific basket of non-profitable, highly speculative technology stocks. These were companies riding the coattails of the AI narrative, raising cash based on pitch decks rather than profits.
The hype machine.
Yeah, that specific basket surged an incredible 127% in just 6 months last year. And that is the true bubble that is rapidly deflating right now.
Wow, 127%. Okay, so what about the massive profitable tech companies then? Why are they sliding if they aren't the bubble?
The market has simply already priced in their initial rounds of AI investments. Now, as Morningstar points out, investors are just taking a pause.
A pause on AI.
Well, think about it. Building these massive AI data centers costs tens of billions of dollars today, but the software subscriptions and enterprise tools that eventually pay for those data centers, that might take years to materialize.
Right, the payoff is delayed.
Exactly. Investors are waiting for clear visibility on how all this massive capital spending is going to translate into actual, tangible new revenue and wider operating margins before they push the Magnificent Seven stocks any higher.
So the rotation we mapped out earlier isn't people abandoning technology entirely. It's the market violently separating the companies that actually print cash from the ones running on pure speculation.
Exactly.
Okay, we've diagnosed the drop, we understand the macro squeeze, and we see what's happening in tech. Now we arrive at the most crucial part of these reports. What do we do with this information for the rest of 2026?
Right, the actionable part.
Are analysts viewing this week's bloodbath as a warning to get out, or is this a buying opportunity?
The consensus from the institutional reports, particularly Morgan Stanley, is that this is a transition period, not an end-of-cycle collapse.
Okay, a transition.
Yes, they are officially labeling the first quarter of 2026 as a soft patch. They fully acknowledge the data is going to look bumpy, largely because of the tariff headwinds and the geopolitical shocks we just discussed. But they are forecasting the economy to firm up significantly as we move into the second quarter and the back half of the year.
Hold on. Morgan Stanley is calling this a soft patch and expecting a Q2 recovery.
They are?
Isn't this the exact same institutional optimism we see right before every major recession? I mean, consumers are currently being strangled by $114 oil, mortgages are back at 6.5%, and the Fed is paralyzed. Why should a listener trust this rosy forecast for the back half of the year?
It's a very fair pushback, and you shouldn't trust it blindly. But Morgan Stanley's argument relies on very specific mechanical tailwinds that the market is currently ignoring out of fear.
What kind of tailwinds?
First, you have fiscal policy. The corporate tax breaks from the OBBA legislation are going to start taking real effect. When corporations pay less in taxes, that cash goes straight to their balance sheets.
Right.
And that allows them to weather high borrowing costs without laying off workers.
So the government is essentially providing a buffer against the high interest rates.
Precisely. Additionally, consumer tax breaks will hit when 2026 taxes are filed, providing a delayed injection of cash to the very consumer that is currently struggling.
Okay, so fiscal help is coming.
Second, the monetary easing from last year, the rate cuts the Fed actually did manage to make before getting stuck, hasn't fully worked its way through the system yet. Monetary policy operates on a long lag.
Okay, so if the institutional expectation is a recovery fueled by fiscal buffers and delayed monetary easing, how cheap is the market right now after this violent rotation? Like, are things actually on sale?
According to Morningstar's intrinsic valuation models, yes. And just to be clear, this is where they look at the underlying cash flow value of over 700 U.S.-listed stocks, rather than just their current stock price.
The real value.
Right. And by that metric, the market is officially on sale. The broad U.S. stock market is currently trading at a 12% discount to its fair value.
A 12% discount across the board is significant. But when Morningstar breaks it down by style and size, the discounts get almost historic.
They really do.
Small cap stocks, which, they get battered the hardest when borrowing costs rise, they're currently trading at a 17% discount.
Right.
And growth stocks, the tech companies that rely on future earnings, are trading at a massive 21% discount to their fair value. And just to put that in perspective for you, growth stocks have traded at this deep of a discount less than 5% of the time since the year 2011.
What's fascinating here is how this extreme volatility creates very specific tactical opportunities.
Like what?
Well, last year, Morningstar and others were practically begging investors to overweight the energy sector. Nobody wanted it, but it was undervalued, paid great dividends, and acted as a perfect geopolitical hedge in case a conflict broke out.
And that hedge worked flawlessly. I mean, energy is the only S&P sector actually in the green so far in March. It was up over 12% this month alone, and it's up 34% for the entire year.
It was a massive win. But here is the critical pivot for the rest of 2026. Because energy has surged so dramatically while everything else fell, Morningstar's data now shows energy is the single most overvalued sector in the entire market.
Ah, so the tables turned.
Completely. So the strategy they are recommending now is a barbell approach.
Okay, break down the mechanics of that barbell approach for someone looking at their portfolio right now.
Think of a physical weightlifting barbell. You have weights concentrated on two extreme opposite ends of the risk spectrum, and you intentionally avoid the muddy middle.
Okay, so extremes.
Right now, Morningstar suggests rebalancing that barbell. It is time to harvest the profits from the energy sector. Take the chips off the table where you won big.
Sell the winners.
Yes. You then take those gains and you slide them over to the opposite end of the barbell. You buy into those oversold, deeply discounted growth and tech stocks that are trading at that 21% discount. You use the market's blind, panicked rotation to your mathematical advantage.
So you sell what the market is currently overvaluing out of fear, and you buy what the market is currently undervaluing out of panic.
That is exactly it.
Wow. So to summarize the incredible terrain we've covered today, yes, the stock market is bleeding heavily under the surface, much worse than the dashboard index numbers suggest. The average tech stock is down 31%.
Brutal.
And this violent churn is being driven mechanically by the geopolitical conflict in the Middle East, oil spikes directly taxing the consumer, and a Federal Reserve that is temporarily paralyzed by the threat of stagflation. However, rather than signaling a total economic collapse, analysts view this aggressive sell-off as a deflation of the speculative AI bubble that has created historic buying discounts, particularly in profitable growth and small-cap stocks. The playbook for 2026 is basically shifting from defense to a calculated barbell offense.
It is. And, if there is one vital paradigm-shifting thread to pull from all of this as we look ahead, it's a concept buried deep in that Morgan Stanley outlook.
Ooh, what is it?
Well, for the past 3 years, the entire financial world has obsessed over every single syllable the Federal Reserve utters about interest rates. We treat them as the ultimate engine of the global economy.
True, every meeting is treated like the Super Bowl.
Exactly. But with the Fed currently cornered and completely paralyzed by the conflicting threats of inflation and recession, we have to ask a bigger question.
Which is,
could the quiet, ongoing wave of global bank deregulation, which is rapidly unlocking trillions of dollars in new lending capacity behind the scenes, could that become the true, unexpected engine that fuels the next economic boom, completely bypassing the Federal Reserve's control?
wow. If banks can lend trillions more without needing the Fed to lower rates, that completely changes how you look at the entire financial landscape.
It changes everything.
Maybe the dashboard isn't just broken. Maybe we've been staring at the wrong dials entirely.
Oh.
Well, thank you all for joining us on this deep dive into the 2026 market turbulence. Keep questioning the headlines, look beneath the surface, and always stay curious.